Good day, everyone, once again. We are going to maintain the standing rule, which is that please always mute yourself. If you have any question to ask, or if you need any clarification, just raise your hand, and then I will allow you to talk. Yeah, in our last class, we started with my scope of performance management. The first topic we discussed was the operating statements. Like I mentioned, it's been a while that ICAN tested it. However, particularly because of marginal costing concepts, so you are going to need the knowledge as we proceed in the diet. Therefore, we just have to do justice to it. Today, we are going to be solving questions. All relevant concepts have been discussed in our last class. Today is just for calculations. If I'm able to solve 2 questions, that's enough. Then if you still have a sufficient time, I can then introduce you to relevant costing. Okay. When we are solving the question, any moment from now, I'll be referring you to some of the concepts that we discussed during our last class. All right. I know some of you are just joining, but notwithstanding, you have not, missed anything. Okay. So let's keep it going from there. Just as a recap, okay, I will not go into details, right? We started with operating statement, and we said that operating statement is a statement that shows the operating performance of an organization at a specified period. The period could be a year, half a year, that is biannual. It could be quarterly, it could be monthly, right? And basically, there are 2 methods of presenting income statement. The first one is marginal costing method, and the second one is absorption costing method. And we said that marginal costing concept is a method that charges the total variable cost of production to the unit cost of a product, all right? And also is a technique that is designed principally to aid managerial decision, meaning that anything that has to do with decision making, you are going to need the concept of marginal costing, because the technique allows management to focus on the areas of the business that are critical to achieving the strategic objective of the organization. All right. Then I also discussed with you the key points or the features you need to consider when you are preparing your income statement using the marginal costing approach. The first point you need to know is that opening and closing stocks are valued at total variable cost per unit. The second point is that fixed production overhead is not part of production cost under marginal costing approach. Rather, it is written off fully from the aggregate contribution. Then point number 3, marginal costing approach does not consider overhead absorption costing, okay? Then point number 4, fixed production overhead and other fixed costs are costs that have no sympathy for activity level, meaning that irrespective of production volume, irrespective of level of activities, fixed production overhead will not change. It will remain constant. Why? Because it is based on the budgeted output. Okay, it is based on budgeted output. It will not change at all. Then finally, marginal costing approach uses contribution margin, unlike absorption costing that uses the gross profit. These are the key points you need to know as far as marginal costing approach is concerned. Then the second method is absorption costing. And we said that absorption costing is a method that charges the total cost of production to the unit cost of a product. That is, it charges both variable and fixed production overhead to the unit cost of a product. And we said that is an account is a concept that relies heavily on the generally accepted accounting principle for external reporting purposes. All right, we don't use assumption costing for decision making. Just like you have your profit or loss account, that is what the assumption costing method does. Okay, what are the points you need to take into consideration? The first point is that opening and closing stocks are valued at total cost per unit. Okay, then point number 2, fixed production overhead is part of a production cost. Point number 3, fixed production overhead will vary. Okay, it will vary depending on the activity level. The more you produce, the more fixed production overhead you are going to incur under the absorption costing method. Then point number 3 or 4 is that absorption costing method uses the gross profit, unlike marginal costing that uses the contribution margin. Then point number 4 or 5 is that absorption costing recognizes the overhead absorption. Okay, so these are the things we discussed last time. Of course, I also provided you with the format of each of them. Then we also talk about overhead absorption costing. What is overhead costing? We said that overhead represents the process of allocating indirect costs, including the rents, depreciation, factory manager's salary, utilities, wages, rates, and all of that. Okay, the process of charging, the process of absorbing, the process of allocating indirect costs to a product or service is what is known as overhead absorption costing. Okay, and we have under absorption, we also have over absorption. We said under absorption will arise when the budgeted overhead is greater than or is higher than the overhead absorbed to a product. Okay, when the overhead charged to a product is lower than the budgeted overhead, that is under. If it is under, it means that the overhead is understated. If the overhead is understated, the profit will be over-reported. All right. So because your overhead, your expenses is lower, then that means your profit will go up. All right. So then in order to correct that, the difference between the budgeted overhead and the overhead absorbed to a product should be added to the cost of goods sold. That's what we discussed last time. Then the second part is over absorption. We said that over absorption will arise when the budgeted overhead is lower than the overhead absorbed to a product. Okay, when that happens, it means that the overhead is overstated. When the overhead is overstated, your profit will be underreported. So the most important thing to do under that circumstance is to deduct the difference from the cost of goods sold in order to reflect the actual plan figures. Okay, so you have to restate everything to the budgeted plan. Okay, and then finally we talk about variance analysis. Okay, we talk about variance analysis, that is reconciliation statement, and we said that the net profit produced by marginal and absorption costing will never produce the same result, because there will always be a conflicting result. Why? Because different methods are used to value stocks. Okay, different methods are used to value stock. Remember, marginal costing approach value stock using the total variable cost per unit, whereas absorption costing approach value stock using the total cost per unit. All right. Therefore, the difference between the two profits should be reconciled using the reconciliation statement by finding the difference in profit before tax and also difference in stock valuation. If difference in stock valuation and difference in profit before tax are equal, it means that you have reconciled the statement. All right, it means that you have reconciled the statement and what you have done is correct. Okay, so that is where we stopped in our last class. So today, like I said, we are going to be doing calculation. If we're able to solve through illustration, that's sufficient. Okay, that's sufficient, because we don't know tomorrow. We don't know where examiner may come out to you. And that's why we just have to touch it. And particularly because of the fact that Marginal costing approach is foundational to some of the topics in performance management, and that's why we just have to touch this. All right. So, like I said, we are not going to solve more than 2 illustrations. Let's start a bit. Now, today, let me put it here for you. You are going to solve this as an assignment. This illustration number 1, you solve it for me. So as an assignment, come here. Okay. So let me put you on your toes. Solve this as an assignment. Solve this as an assignment and submit. So that by the time I'm sharing the working notes, so you will see this and submit not later than Thursday. All right. Which date is next week, Thursday? Today is 17th. 17th plus 6. That's 23, Abby. Okay. 23 or 24, whatever. Just submit next week, Thursday. That's it.
23.
23. Thank you. July 23rd. So that's when we are spread to submit. No story. Otherwise, we are going to embarrass ourselves. Not later. Submit that. Okay. Let's start with illustration number. This illustration number 3. Or let me just pick it in that order. So let's start with illustration number 2. All right, Fernandez. Okay, let me see some of you that are online. So who is going to help us to read it? Somebody should volunteer. Yeah, Festus, your mouth, your mic, your speaker is on. So since you want to read,
Okay, sir.
so read for us, Festus. So Nancy, you will read the next one.
All right, sir.
Go ahead.
Fernandez Company Limited manufactured fish oil. The standard unit cost of its production are given below. Figures are named as read. At normal operating capacity, 200,000 units of product should be manufactured. Variable selling and administrative expenses amounts to 50 kobo per unit, and fixed selling and administrative expenses amount to 75,000 naira a year. Income taxes at 40% of net income before taxes. Production and sales data for the year 2008 and 2009 in units as stated. In both years, each tool is sold for 10.50 kobo. Required. Prepare statement for the years by absorption costing method. B, variable costing method. C, prepare a reconciliation statement to show why there is difference between the results of the two methods.
All right, thank you very much. It's asking you absorption costing method, variable costing method, as well as prepare variance methods. All right. One thing about the word, but the only challenging is time consuming, particularly for the fact that if you are given more than one period, okay, if you are given more than one period, then be rest assured that you are going to spend close to 30 minutes in solving the question. So wasting more time. Now, examiner is asking us that we should prepare income statement using the absorption costing method. All right, so let's start solving it. So as you are, like I mentioned to you last time, my pen is not working. So it's the same document we are going to be using to do justice to the question. So solution. All right. The name of the company is Fernandez. Fernandez. Okay. An examiner is asking us, we are asked to prepare income statement using the assumption costing. So I would then say income statement using assumption costing method. Please, on the day of your exam, don't do this. Don't go and be writing ACM, right? Don't talk performance management to political party, right? It's not the name of a political party. You have to write it out in full, right? Aha. Don't say that's the way Mr. Adeju won't write it in the class. Therefore, you are following Mr. Adeju's approach. Don't do that. Examiner may penalize you because you don't want the examiner to be racking his or her brain that what do you mean by ACM? So in the first instance, you need to write it out in full, right? By stating that income statement using assumption costing method in bracket ACM, so that going forward, you'll be referencing ACM. So in that case, there will be no penalty, no consequence for using ACM. Okay, I believe that is clear. Now, because I'm not using pen, so that's not a limitation. In this question, we have two periods, 2008 and also 2009. Therefore, I'm going to create two columns for each year, debit and credit. All right. So let me come here. I will do description 2008. First thing first, let me do for 3. All right. Don't mind me. Oh, it's for the good. I can't say because my pen is not working then. No class. No darling. All right. So you also learn new things on how to use Word documents, especially if you want to write a book. All right. Let me just first thing first. Let me close this. If you want to write a book, because of time. So let me just because if I begin to do all of this, we'll be here. We'll not leave here today. So let me just I don't have the luxury of time to be doing those kind of adjustments. All right. So no worry. I will soon resolve it. It's only that I don't have the time for now. So here is 2008. 2008. Then here is 2009. Then, of course, I can come here. This will save my time. The same thing you should do on the day of your exam. So instead of me to be writing Naira sign under each year, so you can put it on top. We are putting our values in Naira. Okay. All right then. So based on the formats that you already know, the first item in your income statement will be sales value, isn't it? All right. So let me put this one to the right. Okay. So the first item will be sales value. So I will then come here, sales. You have to support me. Nancy, are you there with me? Bring out your calculator. How do we determine sales for 2008? Go to the question. How many units were sold in 2008? Multiply by selling price of 10 naira 50 kobo. Look up. In 2008, units sold was 160,000. So 160,000 multiplied by selling price of 10 naira 50 kobo. Nancy, give it to me immediately. What do you have there? Nancy, what's the answer?
1,680,000.
I don't want everybody to be talking. That's why I was calling Nancy. It's like she's not available. Oh yeah, let me look for somebody else that will be giving me the numbers so that there's an orderliness in the class. Let me look at. Yes, Festus, continue.
Okay, sir.
Festus, continue. So what do you have?
1,680,000.
So 1,680,000. So that will give us selling price. Let's finish 2008 before we move to 2009. Immediately after sales, remember we are following a format. We already have this format. Immediately after sales, we consider production cost. Okay. Under the production cost, the first item will be opening stock. Before you write it down, you go to the question and check if you are given opening stock. Yes, we are given opening stock of 200,000 at the beginning of 2008. Sorry, that's not. Inventory on hand, that's opening stock, which is 28,000. Remember, because we are using absorption costing method, we said that opening and closing stocks are valued at total cost per unit. So to do this, I will then come here, opening stock. Okay. How do we determine our opening stock? Remember, like I said, we are using absorption costing method. You then go to the question. Since we have opening stock of 28,000 units, then you multiply that with total cost per unit. According to the question, the total cost per unit is 7 naira 30 kobo. This is total cost per unit. Direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. That gives us the total cost of 7 naira 30 kobo per unit. Therefore, Festus, multiply for me. 7.3 multiplied by 28,000. What do you have?
204,400.
204.4. Okay, that's it. Immediately after opening stock, we consider direct material. I will then go to the question and check if I'm given direct material. Yes, we are given direct material cost of 1 naira 60 kobo. Okay, therefore, what am I going to do? Just multiply the cost per unit with the actual unit produced. So, direct material cost per unit is 1 naira 60 kobo. I will then go to the question. In 2008, how many units were produced? 200,000 units were produced. Therefore, 200,000 multiplied by 1.6. Festus, what do you have?
320,000.
320,000. That's direct material. Okay, here is 320. Move to the next one. The next one will be direct labor. Okay, I will then go to the question and check if I'm given direct labor. Yes, we are given direct labor of 1 naira 50 kobo. Then, of course, multiply 1.5 by actual production of 200,000. What do you have?
300,000.
300,000. Here is 300,000. This is direct labor. Like I told you last week, once you master the formats, no issue. All right, you are good to go. No student should fail operating statement because it's it's format driven. Once you master the format, line by line is what examiner will be marking for you. All right. Then I will go back to the standard cost to check if I'm given direct expenses. In this question, we don't have direct expenses, but we are given variable manufacturing overhead of 1 naira 20 kobo. Therefore, I will then come here, variable manufacturing overhead. variable manufacturing overhead, right? Which is 1 naira 20 kobo multiplied by 200,000. What do you have there? I think that should be 240, right?
240,000. Yes.
Good. The next item would then be, I will go to the question to go and check if I have fixed production overhead. Yes, examiner gave us fixed production overhead, fixed manufacturing overhead of 3 naira. Okay, so 3 multiplied by 200,000 units produced in 2008. That will give us 600,000. So I will then come here, fixed manufacturing overhead, 600,000. So you need to add everything together. So first us, add them together. 204.4 plus 320 plus 300 plus 240 plus 600. What do you have?
1664.4.
1664.4. That's it. What do we call this number? This is cost of goods available for sales, COGS. This represents cost of goods available for sales. Okay? Immediately after COGS, remember, we are using absorption costing method. So immediately after COGS, what do? You less closing stock. So I will then come here, closing stock. This will be our number one, our working number one. So closing stock will never be given to you. It's your responsibility. Therefore, we go and do working for closing stock. So I will then come here, workings. Okay. Working number one. We want to calculate closing stock. Closing stock. And remember what I told you, when you are calculating your closing, you have a format that you are supposed to follow. All right, so let me design my table for that. Okay, closing stock. I need three columns. Let me just do 4. All right, so here, 2008 and 2009. I believe you guys are following. You have no choice. You just have to follow. Poco, we are getting closer to the D-Day. Before you know it, September will come. October will come, and then November for your exams. So the first item when you are calculating your closing stock will be opening stock. So I will then come here, opening stock. I gave you the format last time. In 2008, we have opening stock of 28,000 units. Then in 2008, we have actual production. The actual unit produced in 2008 was 200,000. Okay. Then this will give us, the addition of the 2 will give us total units available. Please, if I'm too fast for your liking, you have to speak up. Raise your hand, let me know. Okay? Because that's the reason why you are in class. If I'm taking you and I'm too fast, you have to raise hand so that we slow down. All right, so when you add the 2 together, that will give us 228,000. All right, so it is from this unit available for sales that the company is going to make sales. Therefore, we then deduct units sold. Units sold. So in 2008, how many units were sold? Let's go back to the question. In 2008, the company sold 160,000 units. So I will then less. I will less 160,000. Okay. So what's the difference between the two?
68,000.
68,000. That's the closing stock we are looking for in units. I will then come here, closing stock in units. Okay. So the closing stock in 2008 will become opening stock in 2009. So as at 31st December 2008, the unsold stock was 68,000. So as you move to 1st January 2009, the closing stock will become opening stock. Okay? Therefore, I will then come here in 2009. Opening stock in 2009 will be 68,000. In 2008, how many units were produced? Sorry, in 2009, how many units were produced? The company produced 150,000 units. Okay, so I will then come here, 150,000. Then to get the total units available, you add the two together, 68,000 plus 150,000. That's 218,000. In 2009, how many units were sold? In 2009, the company sold 180,000 units. Minus 180,000. What's the difference? Festus?
38,000.
38,000. So this is how to calculate closing stock in units. So we then need to determine the value of the closing stock. So we need to carry out valuation. Let me move to the next page. We then say valuation. Remember, valuation is unit unsold, or closing stock in units, whichever one you want to call it, multiplied by cost per unit, depending on the method you are using. So in 2008, under the ACM, absorption costing method, how many units were unsold in 2008? Festus?
68,000.
68,000. Then multiply by, remember, we are using absorption costing method. And we say that under absorption costing method, opening and closing stocks are valued at total cost per unit. So according to the question, total cost per unit is 10 naira. Sorry, is 7 naira 30 kobo. That's the standard cost per unit, 7 naira 30 kobo. Therefore, you multiply 68,000 by 7.3. What do you have?
496,400.
496,400 naira, 486,400 naira. Again, in the same year, under marginal, is it marginal or variable costing method? Which one is examiner? Variable costing. You have to use the name examiner has called it. All right. So under variable costing method, in the same year, the same 68,000. And we said that under variable costing method, either you call it variable costing, marginal costing, direct costing is the same thing, right? So under the variable costing method, opening and closing stocks are valued at total variable cost per unit. So according to the question, total variable cost per unit is 4 naira 30 kobo. How do I arrive at 4 naira 30 kobo? In the question, we are given direct material of 1 naira 60 kobo, direct labor of 1 naira 50 kobo, then variable manufacturing overhead of 1 naira 20 kobo. When you add the three together, it will give you 4.3. Okay? So I will then come here, I will multiply, all right? I will multiply 68,000 by 4.3 naira. What do you have?
292,400.
Take it again. To what?
292,400.
292,400.
292,400.
All right, so that's it. So we are done with 2008. Let's just do 2009 so that we know that we have completed our workings for closing stock. In 2009, under ACM, how many units were unsold? In 2009, 38,000 units were unsold. Therefore, 38,000 units multiplied by 7 naira 30 kobo. What do you have there, Festus?
277,400.
277,400. That's it. Then under variable costing method, 38,000 units multiplied by 4 naira 30 kobo. What do you have?
163 naira. 63,400.
400. So that's it. So we are done with the workings for closing stock. So right now we are calculating for using absorption costing. So closing stock in 2008 is 496.4. So like I said, please, if there's anything that is not clear to you, always raise your hand, ask questions so that you can get clearance. You can get clarification. Very, very important. All right. Don't assume that you have to ensure that you understand it. All right. So Festus, what's the difference? 1664.4 minus 496.4. What you get?
1168.
Festus?
1168.
So 1168. What do we call this 1168? This represents cost of goods sold, isn't it? Yeah.
Yes, sir.
This is cost of goods sold. I'm coming for you, Amarachi. So cost of goods sold. That's it. You can see it's not difficult. Yes, talk to me, Amara.
Hello, good evening, sir. So I sent a message, but let me ask. So I was like, what if the material cost, the labor cost, and the variable cost per unit was not given, but we have the value? So how can we now calculate the opening stock and the closing stock?
If you are given a value, then first thing first you need to do, all you need to do is to divide the total cost given to you by the number of units produced. So that will give you the cost per unit. You get? Now, let me demonstrate that for you, Amara. This is what you are saying. For example, you are given direct material. You are given direct material. Okay. In total value. Let's say you are told that direct material is for simplicity 10,000 naira. Okay. Right. You're also given direct labor. Direct labor to be, let's say, for example, 15,000 naira. Okay. Just for demonstration purpose. Then you're also given unit produced or production. Either your examiner can call unit produced or output, whatever. So let's say unit produced is for simplicity, all right, 5,000 units, all right, and you're also given opening stock. For example, you are given opening stock of 2,000 units, all right. So Amara, so these are the hypothetical figures that we can use to demonstrate this. So as you can see from here that because we are given total direct material costs, total direct labor costs, right? Let me also add, let's say we are also given a variable, right? Variable overhead, right? To be, let's say 5,000. You are given fixed overhead to be, let's say 3,000, or let me put it as 6,000. All right, so these are the hypothetical numbers. So because the figures, our costs are given to us in total, we are not given cost per unit. So the first thing you are going to do for me to be able to value this opening stock, the first thing I need to do is to convert to determine cost per unit. I need to determine cost per unit. So in this case now, if I want to determine my cost per unit, I will just say total cost, which is 10,000 naira, divided by the unit produced. Unit produced is 5,000. Therefore, this will just be 10,000 divided by 5,000 units. That will give us 2 naira per unit. That will give us 2 naira per unit. You do the same thing for labor. Labor will be 15,000 naira, then divided by the actual unit produced, which is 5,000. So this will give us 3 naira per unit. I will do the same thing for variable overhead. Variable overhead is 5,000 naira divided by unit produced of 5,000. Okay. So this will give us 1 naira. I'll do the same thing for fixed production overhead, fixed overhead. Here will be 6,000 divided by 5,000. So you are going to have 1 point something. Let me check my calculator.
1.2.
1.2. This will give us 1 naira 20 kobo. So by the time I had everything together, 2 naira plus 3 naira, that's 5 naira, right? Plus 1 naira, that's 6 naira. Plus 1 naira 20 kobo, that's 7 naira 20 kobo. Therefore, to now value my opening stock, I would then say 2,000 units multiplied by 7 naira 20 kobo. Whatever I get, that will be the value. Amara, is it clear now?
Very well, sir. Thank you so much, sir.
You're welcome. So let's move on. This is not part of our solution. So, except you are in the class or you are listening to the video, you just be wondering what's the meaning of this. In any case, let's move on. All right. So immediately after cost of goods sold, what do? Remember, we are using a format. When you are using absorption costing method to prepare your income statement, immediately after cost of goods sold, you have to consider overhead absorption costing. You want to know whether your overhead is under or over absorbed. Therefore, before you put it down, before you write anything down, you need to go and do your working to be sure that whether it is under or over before you write it down. You can't just write under/over, then you leave it open. No. First thing first, go and do your workings. Ensure that you are doing the right thing. So I will then come here, working number 2 now. This is working number 1. Okay. Then working number 2. I did not ask you for that. Number 1, then working number 2. We start from here. Overhead assumption. Let me call it under/over assumption. Okay. So in this question, we are not given overhead in naira. So we are given units. We are given units produced, and then we were also given the budgeted output. Therefore, there will be two stages for your overhead absorption calculation. The first stage is to determine the unit variance. Then you now multiply fees overhead absorption rates on the unit variance. So we have 2 years, 2008 and then 2009. So let me create a table for that. So 2008, then 2009. So the first item here will be budgeted output. So here will be budgeted output. So I will then go back to the question. In 2008, how many units were budgeted for? Let's go back. According to the question, we are told that at normal operating capacity, 200,000 units of products should be manufactured. That's the planned estimates. This is the budgeted output. The company plans to produce 200,000 units. So we want to compare the units produced versus the budgeted output, whether it will result in under or over absorption. Okay? So budgeted output is 200,000 units. So here will be 200,000. All right. So 200,000. In 2009 is the same thing, 200,000. Okay. Yeah, we then compare this with production, actual production. In 2008, how many units were produced? In 2008, the company produced 200,000 units. In 2009, 150,000 units were produced. So 200,000, 150,000. That's it. It's no more than that. Okay. So what's the difference? This will be the units variance. All right. So in 2008, the overhead is rightly or appropriately absorbed. The unit budgeted for is what is absorbed to a product. So it's the same thing, no issue. But in 2009, that's a difference of 50,000, right? Unit variance in 2009 is 50,000. Remember, in my explanation of overhead absorption costing, and I mentioned that it will be under absorption when the budgeted overhead or output is greater than the overhead absorbed to a product. Once the budgeted output or budgeted overhead is greater than actual output or actual overhead, then it means that it is under assumption. It is under assumption. But if otherwise, if budgeted output or overhead is less than the actual output or overhead, it means that it is over absorption. Okay, so that's that. So the next thing I need to do now is to then determine for my overheads, overhead absorbed to a product will then be equal to the unit variance multiplied by fixed overhead absorption rates. Okay, overhead absorbed to a product is calculated as unit variance multiplied by overhead multiplied by fixed overhead absorption rate. So in this question, the fixed overhead absorption rate is 3 naira. Therefore, in 2009, we have under absorption. Okay, in 2009, we have under absorption. So I will then come here under absorption. Why is it under? Because the budgeted output is higher than the actual output. That's why it is under. If it is under, what do? You add. So this will be unit variance of 50,000, then multiply by fixed overhead absorption rate of 3 naira. So what do we have here? This will give us 150,000 naira. That's it. That's it. It's not more than this. Don't forget what I said. If you have any question, always raise your hand. This is working number 2. Okay. All right. So 150,000. I will then come here. We have under absorption. Under absorption, this is working number 2. All right. But that would be in 2009. Okay, in 2009, here we have 150,000. All right. So here we have nothing. There's nothing in 2008. Therefore, to get the gross profits, let me bold this one. So to get the gross profit, what do? You deduct the difference or whatever you have here, the addition of these two, whatever it is, let's say from the sales value. Here is 1,168. So Festus, what's the difference?
512.
5 what?
12. 512.
5-1. So this 512, what do we call it? This is gross profits. That's why we said that absorption costing method uses gross profits, unlike marginal costing that uses the contribution margin. So this is what I was trying to refer to. Okay. Next, after gross profit, what do? You then consider non-production costs. Okay, non-production costs. Any cost that is not related to production, be it variable or fixed, will come under the non-production cost. So I will then go to the question to go and check if I have any variable cost or fixed cost that is not related to production. All right, all these ones are production cost per unit. So we then go to the additional information. In the question, we are told that variable selling and administrative expenses among units. Okay, variable selling expenses is 50 kobo per unit. So I can also do working for that for the purpose of this class. Ordinarily, I don't need to do working if I'm the one solving this. I will just carry my calculator. All right, 50 kobo multiplied by units sold for each year, I will get my answer. But because for the purpose of the class, I will do working for that. Selling, variable, selling, and admin expenses. Okay. This should be working number 3. All right, let me bold this. So in 2008, variable selling expenses will be equal to, in 2008, how many units were sold? 160,000 units were sold in 2008. So I will then come here, 160,000 units multiplied by the variable selling and administrative expenses. We are told is 50 kobo. 50 kobo is the same thing as 0.5. Therefore, what do we have? This will give us 80,000 naira. Then in 2009, how many units were sold? In 2009, 180,000 units were sold. 180,000 units. Then multiply by 50 kobo, 0.5. This will give us 90,000 naira. That's it. That's it. It's no more than this. Who is that person? All right. So now that we have variable selling and admin expenses for 2008 to be 80,000, let's go and post it. So I will then come here, variable selling and admin, working number 3. Okay. So we got 80,000 naira. I will go back to the question again to go and check if I'm given any fixed costs not related to production. So according to the question, we are told that fixed selling and admin expenses amount to 75,000 naira a year. All right. So fixed selling expenses is 75,000. It's not related to production. It's a selling cost. It's a fixed selling cost. So I will say fixed. Let me copy this. Fixed selling. We are told it's 75,000. So I will then add the two together. I will add these two together. So that will give us 155,000. No other cost again. So 155,000. So Fextors, 512
Yes,
minus
sir.
155. What do you have?
357.
357. What do we call this 357? That will be profit before tax.
Profit before tax.
Profits before tax. We are using a format. Let me bold this. Then, immediately after profit before tax, we then go back to the question and check if we are given income tax. So according to the question, we are given tax rates. We are given tax rates of 40%. Therefore, we need to include that in our calculation. Income tax at 40%. So I will just say profit before tax multiplied by 40%. Festus, give it to me. What do you have? What's 40% of 357? 142.8. So what's the difference? What's the hiatus? What's the difference? Let's move fast. 21 what?
214.2.
214.2. What do we call this 214.2? That is net profits.
Profit.
So you can see We are done with 2008. We are done with 2008. Let's move to 2009. If you have any question or if you have any concern, let me know on time. Okay? So, in the absence of no question for now, let's move to 2009. All right. Time is it's running faster than usual. Oh, yeah, now. So in 2009, how many units were sold? In 2009, 150,000, let me confirm. Yeah, in 2009, 180,000 units were sold. Therefore, 180,000 units multiplied by selling price of 10 naira 50 kobo. What do you have there?
1,890,000.
1,890. All right. Then we need to determine production cost, right? The same way we did for 2008. In 2009, the company produced 150,000 units. Therefore, direct material cost will then be 1 naira 60 kobo multiplied by 150,000. What do we have? Before that, okay, 240,000. Now, opening stock in 2009, pay attention, please. The closing stock of 2008, right? The closing stock of 2008 will become opening stock at the beginning of 2009. This will be 496.4. Okay? Then direct labor cost. Direct labor cost per unit is 1 naira 50 kobo multiplied by 150,000 units produced in 2009. What do you have? 1.5 multiplied by 150.
225,000.
225. Then variable manufacturing overhead, 1 naira 20 kobo multiplied by 150,000 units. What do you have?
180.
180,000. Then fixed manufacturing overhead, 3 naira multiplied by 150,000 units.
450,000.
450,000. Okay, so add everything together. What do you have? Add all of this. 496.4 plus 240 plus 225 plus 180 plus 450. What do you get?
1591.4.
159.4.
1591.4. Yeah.
Okay. All right. So that's our COGS, cost of goods available for sales. We then go and pick the closing stock in 2009. We have done the working already. 2009 closing stock under ACM, absorption costing method. That's 277.4. 277.4. So what's the difference? Festus.
1314.
1314. All right. Oh, sorry. This is our figures are in thousands. Now, remember, immediately after cost of goods sold, we are supposed to adjust for absorption. We are supposed to adjust for overhead absorption. Therefore, remember last week I was telling you that fixed production overhead under absorption costing method will vary depending on the activity level. Now, in 2008, the fixed manufacturing overhead was 600,000 naira. Remember, the budgeted output is also 600,000 naira, because when you multiply 3 naira by 200,000 budgeted in units, so that will give us 600,000. And that was why in 2008, overhead absorption was 0. We do not have anything in 2008, it was 0, because what was budgeted for is what was absorbed to a product. However, when you look at 2009, our production, our budgeted overhead still remains 600,000 naira. That is 200,000 units multiplied by 3 naira. But when you look at the overhead charged to a product, the fixed manufacturing overhead charged to a product in 2009 was 450. It means that the overhead is under absorbed, and that is why you are seeing this 150 here. This is the 150 we did the calculation the other time, working number 2. So because it is under absorbed, what do? We are going to add it to the cost of goods sold. So, and I also mentioned to you last week that the fixed manufacturing overhead or fixed production overhead will vary depending on the activity level. In 2008, we produced 200,000 units. We got the fixed overhead was 600,000. In 2009, we produced 150,000 units. The fixed manufacturing overhead has reduced to 450. So it will continue to vary depending on the activity level. All right. So Festus, add it together. 1314 plus 150. What do you have?
1464.
1464. So 1464 minus 1890. What do we have?
426.
426. That is called gross profits. After gross profit, we consider variable selling, we consider non-production cost. So we have done the working. So let's go and pick it. Variable, yeah, in 2009, variable selling and admin expenses is 90,000 naira. So I will come here, 90,000. Fixed selling and admin is 75,000. It is constant. So you add the two together, that's 165. 426 minus 165. Festus, what do you have?
261.
261. Okay,
Yes,
so that gave up profit before tax. 261 multiplied by 40% tax. Yes.
Then
First
104.4.
104.4.
4.
So what's the difference?
156.6.
156.6. That's it. This is net profit for 2008. We are done with absorption costing method. Let's go to marginal or variable costing method. So let me know if you have any question on this before we move to the next one. Any question on this so far? If there is no question, then we'll move straight to variable costing method. Okay. So let me just copy. Okay, I'm not ready yet. So number B. This should make my life easy or easier. I don't need to stress myself since I already have it as a table. So here will be number B. You can't do the same on the day of your exam because you can't just copy and paste. All right. So this will change. Remember, here we are using variable costing method or marginal costing method. So it's not the same thing, but some of the figures are the same here. Under the variable costing method, our sales value will remain the same. Our opening stock will change. We can't have the same opening stock again. So we need to go and do calculation for our opening stock. Now, Festus, remember,
Yes, sir.
we said that under variable costing method, opening and closing stocks are valued at total variable cost per unit. And according to the question, total variable cost per unit is 4 naira 30 kobo. Therefore, 4 naira 30 kobo multiplied by opening stock of 28,000 units. What do you have?
Um, 120,400.
120.4. That's the opening stock. So direct labor, direct material, direct labor, variable overhead will remain the same as under the absorption costing method. And I also told you last time that using marginal costing approach, fixed production overhead is not part of production cost. So this fixed manufacturing overhead is not part of production cost. We delete it. All right. So let's determine our cost of goods available for sales. Festus, add it together. 120.4 plus 320 plus 300 plus 240. What do you have?
980.4.
980.4. That's cost of goods available for sales. We then go ahead and we've already calculated our closing stock under variable costing method. In 2008, closing stock is 292,400. So I will come here, 292.4. What's the difference? 980.4 minus 292.4.
688.
688. Now, every other thing here will not work again. So we have to recalculate it. Immediately after our cost of goods sold using marginal costing approach, what do? You consider variable non-production costs. So variable non-production costs. In the question, we only have one variable non-production cost, which is variable selling and admin expenses. So I will then come here, variable selling and admin. I think that's working number 3 we did before. Yeah, working number 3, 80,000 in 2008. Here is 80,000. This one will be 90,000. So first us add it together. 688 plus 80. That's 768. So 1680 minus 768. What do you have?
912.
912. What do we call this 912 under marginal costing approach? This is called contribution margin. This is contribution margin. Immediately after contribution margin, the next thing we are going to do is to deduct period cost. Remember, under marginal costing approach, we said that marginal costing approach is an accounting system whereby the period cost incurred are written off fully from the aggregate contribution. So we deduct period cost. According to the question, one of the period costs is fixed manufacturing overhead. Fixed manufacturing overhead. And I told you that the fixed production overhead or fixed manufacturing overhead will remain constant. Why? Because it is based on the budgeted output. It's not based on actual production. It's based on budgeted output. So, according to the question, the budgeted output is 200,000 units. Fixed overhead assumption rate is 3 naira. Therefore, 3 naira multiplied by 200,000 will give us 600,000. So here will be 600,000. So you can come here to say 200,000 multiplied by fixed overhead absorption rate of 3 naira. That's how we got the 600,000. Okay. Then we also have fixed selling expenses. Fixed selling and admin expenses. According to the question, is 75,000. Okay, so you add the two together. 600,000 plus 75,000 will give us 675. So 912, Festus, 912 minus 675, what do you have?
237.
237, 237. What do we call this? Profit before tax. This is profit before tax. Then we charge income tax, which is profit before tax multiplied by 40%. You can see it's not difficult. Just know what you are doing. So what do we have here? What's 40% of 237?
94.8.
What did you say? 94?
9.8.
94.8.
Yes, sir.
So what's the final answer?
142.2.
142.2. That's the net profit for 2008. We then move to 2009. The closing stock of 292.4 in 2008 will become opening stock in 2009, 292.4. All right. So add it up. Festus, add the 4 line items. What do you have there?
937.4.
Did you say 937?
Yes, sir. 937.4.
Okay. Then the closing stock in 2009 under variable costing method was 163.4. 163.4. 163.4. So what's the difference? 937.4 minus 774. All right. Then you add up variable selling and admin. 774 plus 90.
864.
864. Then period cost. Remember what I told you. Using marginal costing approach, fixed cost will remain constant. It will not change because it is based on the budgeted output. So fixed manufacturing overhead will remain 600,000 because our budgeted output is still the same 200. Then fixed selling and admin expenses too is 75,000. So add it up, that's 675. 675 minus 1890, what do you have?
1215.
1215. Okay. 1215. Oh, sorry, something is missing here. Is it? No, something is missing. I did not deduct This one's supposed to, sorry, it's supposed to be 864, supposed to come here, 864. Oh yeah, 864 minus 1890. What do you have?
1026.
1026. 1026. 1026 minus 16 minus 675.
351.
351. 351 multiplied by 40%.
140.4.
First thought.
140.4.
140.4. What's the difference? 351 minus 140.4.
210.6.
210.6. That's the net profits in 2009. So the next thing we are going to do now, of course, we just answered requirement number A and B. All right, we have completed requirement A and B. The next thing we are going to do is to prepare the reconciliation statements. Okay. So I will then come here. Reconciliation statements. Let me copy this. Number C, reconciliation. Okay. Our figures still in thousands. I don't need all of these figures. So the next thing we are going to do now is to then the first item under the format for calculating reconciliation statements. The first item will be profit before tax. We are looking for difference. Difference. What's wrong with you? Difference in profit before tax. So I will then go to the question. Under ACM, absorption costing method, then under variable costing method. So in 2008, we calculated profit before tax in 2008 under absorption costing method was 357. So here is 357. Under marginal, under variable costing method, 237, 237. So what's the difference? 120. That represents difference in profits. In 2008, difference in profits. Okay. We then move on to this to determine difference in stock valuation. All right. So difference, or simply say stock valuation. All right. Under the stock valuation, the first item will be closing stock. So I will then go to the question for ACM and then VCM. What's the value of closing stock? I think it's under here. We've calculated it before. In 2008, closing stock was 296.4. 296.4. Then, under marginal, closing stock for marginal, 2008, it was 292.4. 292.4. Festus, what's the difference?
4.
Check that again.
4.
4. Okay. So the difference is 4,000. Our figures are in thousand. So the difference is 4. So I will then come here. No, closing stock is 496. Can't be. Closing, sorry, it's 496.4. That's the 496.4. So that will give us what? 104, right?
204.
Is it?
204.
204. Yeah. Okay, 204. So that will give a difference in closing stock. All right. You then find difference. Let me remove both. We then find difference in opening stock. So opening stock. Under ACM and then MCM, sorry, VCM. The opening stock in 2008 under ACM, opening stock, ACM, we have 204.4. 204.4. So you come here, 204.4. Under the variable costing method, 120.4. So what's the difference? Festus?
84.
84. Then 204 minus 84. What do we have there?
120.
120. That's it. This is difference. Difference in stock valuation. All right, let's bold it. So we then move to 2009. The profits before tax under the ACM in 2009 was 261. Okay, 261. So here will be 261. Under the variable costing method, 351. 351. So what's the difference between the two? That should be minus 90,
Minus
right?
90. Yes.
Okay, then. So closing stock in 2009 under the ACM, closing stock was closing stock, that's 277.4. Okay, 277.4. Then variable costing method, closing stock in 2009 was 163.4. 163.4. What's the difference?
114.
114. We then deduct difference in opening stock. The closing stock in 2008 will become opening stock in 2009. So 496.4 minus 292.4. What's the difference?
204.
204. 204. 114 minus 204. What do you have?
Minus 90.
Minus 90. That's it. That's end of the question. That's end of the question. So let me know if you have any question for me so that we can solve one more illustration. It's not more than that. You will notice that difference in profits in 2008 equal to difference in stock valuation. In 2009, difference in profits also equal to difference in stock valuation. Once you have this kind of alignment, it means that you are good to go. It means that what you have done is perfectly okay. So you can be rest assured that you can pocket 15 or 20 marks, depending on the marks allocated to the question. So it's not more than that. Let me know if you have any question. If not, we'll move on to solve another illustration. All right. So let's solve another one. Let's move to illustration number 3. Thank you, Festus, for being my partner on the question of Fernandez Manufacturing Limited. So let me look for another partner. Nancy, are you still there? Nancy, baby. She has disappeared. All right. I need a BBC caster to do justice to this question. I need a BBC, CNN, International. Who is helping us? Hello? Who is helping us to read the question and be the provider or supplier of answers? Let me look for one of you. If you're not ready. Isn't name, baby? Oh yeah, now. Isn't it? Or are you attending by proxy? Frances.
Yes, sir.
Okay. Okay, isn't it? All right,
Okay.
then. Thank you. So you'll be my supporter on this question. You will read, then you provide me with the answer from your calculator. All right. So
Okay.
read for us. Panama Limited.
Panama Limited makes and sells one product, which has the following standard production costs. Direct labor, 3 hours at 6 naira per hour.
Okay, you can leave the cost per unit. Move to the next paragraph.
Okay, normal output is 16,000 units per annum. Variable selling, distribution and administration costs are 20% of sales value. Fixed selling, distribution and administration costs are 180,000 per annum. There are no units in finished goods inventory as at 1st October 2014. The fixed overhead expenditure is spread evenly throughout the year. The selling price per unit is 140 naira. Production and sales budgets are given below. Required. Okay. Prepare operational statement for each of the 6 monthly period using a marginal costing techniques, B, absorption costing techniques.
Thank you very much, Ezinne. So that is the question. That is the question. The name of this company is Panama. So I will then come here, just like we saw for the first one, solution. The name of the company is Panama Limited. Okay. Let me reduce the gap. Okay. So this is the name. Then in the requirement number A, we are to prepare operating statement. I will then come here, operating statements using the first method. We are told to use marginal costing. So using marginal costing method, marginal costing technique is what the examiner call it. Okay. Our figures will remain in thousands. This will save time. All right. So I will then go up there, go and copy what we have done before under the variable. So I will copy this. I'm going to need the table. All right, this will make our work faster. Okay. That's it. So this is number A. Requirement number A. All right. Let me bold this. Let's remove the figures. So pay attention to this. You have to be very careful with this kind of question. All right. If you don't pay particular attention to the dictate of the question, you may not get it correctly. So let's go through it together. You are told in the question that we want to determine our sales value, right? However, this question is for period ending 6 months, ending 31st March 2015. So we have March 2015. We also have September 2015. So I will then come here, March, and then September 2015. Okay, so we need to determine sales value in March. I will then go to the question, how many units were sold in March? The company sold 7,000 units. What is the selling price? Selling price per unit is 140 naira. So isn't it 140 multiplied by 7,000? What do you have?
980,000.
980,000. So I would then come here 980. All right. So we are going to ignore September for now. Let's concentrate on the March 2015. Then we want to determine production costs. The first item is opening stock, right? So I will then go back to the question, are we given any opening stock? No, we are not given opening stock. Therefore, we are going to ignore it. Nothing will be there, just put a dash. The next one is direct material. I will then go to the question to confirm if I'm given direct material cost per unit. According to the question, direct material cost per unit is 28 naira. Therefore, how many units were produced in March 2015? In March 2015, how many units were produced? The company produced 8,500. Therefore, 8,500 multiplied by 28 naira. What do we have? Isn't it?
23,000 and 238,000.
238,000. So here will be 238. Then I will go back again in the question whether I have direct labor. Yes, we are given direct labor of 18 naira. So 18 multiplied by 8,500. What do you have?
153,000.
153. Here is 153. Then also, I need to go and check if I'm given direct expenses. So according to the question, we are not given direct expenses. We are given variable production overhead of 3 naira. So 3 naira multiplied by 8,500. What do you have?
25,500.
25.5. Our figures are in thousand. So variable production overhead. Yeah. So this one is variable production overhead, not manufacturing overhead. Variable production overhead. So because we are using marginal costing technique, so we are not going to include fixed production overhead. Therefore, add the three together. What do you have, isn't it?
416.5.
416.5. So that gives us cost of goods available for 0.5. So that gives us cost of goods available for sales. We have done, okay, we need to go and do our workings for closing stock. All right. So I would then say
0.5.
Workings. Working number one will be closing stock. The same way with, let me even copy what we did before. That will make it faster. Yeah. In case we have absorption as well. So let me just copy all of this. Okay. So we're picking it one after the other. So right now we are doing closing stock. This is for the month of March, period ending March, then period ending in September. All right. So delete all of this. It's the same format. So in March, we don't have opening stock. Therefore, you put a dash, no opening stock. In March, how many units were produced? 8,500 units were produced. In March, how many units were sold? 7,000. So here is 8,500 plus 0 will give us 8,500. Then minus 7,000. So closing stock will then be equal to 1,500. Right? Let me check. Yes, 8,000 minus 7,000. That's 1,500. Okay. Then at the beginning of, by 1st of April, the closing stock in March will become opening stock. So here will be 1,500. The actual production in September, the company produced 7,000 and sold 8,000. Here is 7,000 plus 1,500, that's 8,500. Minus 8,000. So the closing stock in units will be 500. Let me confirm the sales. Yes, 8,000. All right. So the next we need to do is to carry out the valuation. So in March, 2015. Under the variable costing method, under the marginal costing technique. Using marginal costing technique, absorption costing technique. So using marginal costing technique, variable costs, on sold stock is 1,500. Then what's the total variable cost per unit? Let's go back to the question. Total variable cost per unit. Out of the 69 naira, 20 naira is for fixed production overhead. That means when you add up 18 plus 28 plus 3, that will give us 49 naira. Variable cost per unit is 49 naira. So here is 49. Isn't it 49 multiplied by 1,500? What you get? Isn't it? Are you still there? Okay. Let me use my calculator because of time. I'm not sure if Isn't is there or maybe serving network issue. 1,500 multiplied by 49. That's 73,500. 73,500.
73,500.
Okay, you are back. So here is 69.
Yes, sir. Sorry.
It's okay. Here is 69. Multiplied by 1,500. What you get?
103,500. 103,500.
500. That's okay. So that's it. So we are done with, let's just do September. September. Let me shorten it. 2015. So let me just copy and paste here. So in September, we only have 500 units. So 500 multiplied by 49. What do you have?
24,500.
24,500. 500 multiplied by 69.
34,500.
34,500. So that's that. So let's go and post. We are using MCT, marginal costing approach. So closing stock for the period ending March is 73,500, 73.5. So closing stock is 73.5. So what's the difference? 416.5 minus 73.5.
343.
343. Oh, sorry.
Yeah.
343. Then variable non-production costs. Let's go back to the question. If you have any variable non-production costs, according to the question, we are told that variable selling, distribution, and admin costs are 20% of sales value. All right. Variable selling, distribution, and admin costs are 20% of sales value. Therefore, I would then come here, variable selling, distribution, and admin. Okay. Distribution and admin. We are told in the question is 20% of sales. Let me shorten this so that we can have sufficient space. Variable selling, distribution, and admin equal to 20%. 20% multiplied by sales. Who is that person making noise in my class? Be careful. Oh yeah, isn't it? What's 20% of 980 was the sales?
980.
Wisdom, be careful. You are the one disrupting my class.
196.
So
196.
980 multiplied 196. Thank you. So here will be 196. All right. So if that is the case, then what do? You add it up. Add it up with 343. Yes.
539.
539.
539.
Okay. 539. 980 minus 539. What you get?
441.
441. That's contribution margin. We then less period cost. We go back to the question to check the fixed cost given to us. According to the question, we are given a fixed cost. According to the question, we are told that the fixed production overhead is 20 naira. Okay, fixed production overhead is 20 naira per unit. That's a fixed overhead absorption rate. Then, according to the question, you are given normal output. Remember, we are using marginal costing technique. So under marginal costing technique, fixed production overhead will remain constant because it is not part of it is not part of production cost. So it will remain constant. And of course, because it is based on the budgeted output. So according to the question, budgeted output is 16,000 units per annum. Pay attention to this, please. Normal output is 16,000 units per annum. Remember, period ending March is for 6 months. Period ending September is also for 6 months. So you have been given normal output for 1 year. So you need to divide this 16,000 units by 1 year. Sorry, that will give us 6 months. So 6 over 12 multiplied by 6,000, that's 8,000 units. All right. Then fixed overhead absorption rate is 20 naira. So let's go and do working for that. Working number 2 now. All right. Working number 2. We want to determine fixed production overhead, FPO. So, according to the question, fixed production overhead, we are given it as 16,000 units per annum. So we need to divide that into 2 because we calculate for March and also for September. This is working number 2. So I will then come here. My fixed production overhead will be units, budgeted units, multiplied by fixed overhead absorption rate. So for period ending March, this will be equal to budgeted units according to the question is 16,000 for 1 year. All right, 16,000 units for 1 year. So we need to divide it into 2. This will then be multiplied by 6 over 12. Okay, let me just do it this way. Let me copy this. Yeah, I don't waste my time. 1 minute. Okay, so here is 16,000 units. All right, divided by 2. Okay, let me do it this way. Instead of divided by 2, let me do it this way. This is 6 divided by 12. All right, then multiply by 16,000 units. Remember, this 16,000 units is for 1 year, right? But for March will start from October. When you calculate from October to March, to end of March, that will give us 6 months. So that means you are supposed to take 6 months of the 16,000 units, all right? Then whatever you have, multiply by the fixed overhead absorption rate. Fixed overhead absorption rate, according to the question, is 20 naira. Therefore, give it to me. 8,000 multiplied by 20 naira will give us what? 160,000.
Yes.
So that is for the period of March. Okay, then we do for September once and for all. For September, it's the same thing, just repeat it. All right, that's it. It's not more than that. That's what the examiner is one of the things that the examiner has hidden in this question. If you do an average student, because you are so much in a rush, oh, this question is straightforward. You just pick the 16,000 units, you multiply with 20 naira. You get 320. You get 16,000 units is for 1 year, and you are calculating for March. March is just for 6 months, so you cannot recognize 12,000 units. All right, so that is that. Then let's go and post. Fixed production overhead. Here is fixed. We've already done working for this. That's working number 2 now. Working number 2. Okay. Fixed production overhead. We calculated 160. Then we go back to the question to check in case we are given other fixed costs. In the question, we're also given fixed selling, distribution, and admin costs to be 180,000 naira per annum. So 180,000 naira per annum. And because we are not doing for the whole year, this is for 6 months. So we need to divide it by 2. Fixed, I can say fixed selling, distribution, and admin. Is calculated as 180,000 divided by 2. All right, 180,000 divided by 2, that's 90,000. So 90,000 plus 160, what do you have? Isn't it? That's 250, right?
50.
So 441. So 441 minus 250. What do you get?
191.
191. So in the question, we don't have tax. We are not given tax rates. Therefore, there's no need for you to calculate for income tax. Let me check in case we have other costs. No other cost again. All right then. So let's delete this one. It's not needed. That means our net profits and profit before tax will be the same thing. So this will be the same thing. That's it. So let's do for let's do for September. In September, how many units were sold? The company sold 8,000 units. Therefore, 8,000 multiplied by 140 naira. What do you have? Isn't it?
112,000 be 20,000. 1,120,000. Yes, 1,120,000.
Are you sure? 8 multiplied by 140. 1,120. Okay, that's it. Then the next one, opening stock. So the closing stock in March will become opening stock at the beginning of as the 1st of April. Therefore, here will be 73.5. Then direct material. According to the question, direct material cost per unit is 28 naira. So 28 multiplied by unit produced, 7,000. 28 multiplied by 7,000, what do you have?
196,000.
196. Direct labor, 7,000 multiplied by 18 naira. 7,000 multiplied by 18. 126. Okay. Then variable production overhead, which is 3 naira. So 3 multiplied by 7,000. What do you get?
21,000.
21,000. So add it up. 73.5 plus 196 plus 126 plus 21. What you get?
416.5.
416.5.
Yeah.
So we have calculated closing stock already for 2000 and for September. All right, September. So September is 24,500, 24.5. 24.5. You can see, like I mentioned the other time, it's straightforward, but it takes time to solve, especially when you are given more than one period. So give it to me. What's the hiatus? What's the difference? 416.5 minus 24.5.
392.
Pardon?
392.
Okay, so variable selling, distribution, and admin expenses. 20% of 1120. 20% of 1120. What do you have?
400.
224.
22400.
Okay.
224. Yeah.
So plus 392. That's 616, right?
616.
616. So 1120 minus 616.
504.
504. All right. So let's period cost. Like I mentioned, when you are using marginal costing, period cost will remain the same. Your fixed production overhead is not changing. It's the same thing, and we have done the working before. This is working number 2 here. It's 160,000. All right. So to remain constant, it's 160. Then fixed selling, distribution, and admin, the same thing, 90 naira. All right. So here will be 250. So 5404 minus 250. What do you have?
254. 254.
That's it. That's it. It's no more than this. So let's solve for the last one, which is to solve for using absorption costing technique. Okay, let me copy the one we have before, or let me just use this one. Let me use this one. Okay. So number B, requirement number B, using absorption costing method. So the sales value will remain the same. Opening stock in March is 0. We don't have opening stock. So the next thing we are going to do is to introduce fixed production overhead. because we are using absorption costing technique. Let me remove all of this. So we then go back to the question. The fixed overhead absorption rate is 20 naira in the question. The fixed cost per unit is 20 naira. So in March, the company produced 8,500. Therefore, 8,500 multiplied by 20 naira. What do you have?
170. 170,000.
170. So add it up. What do you have?
586.5. 586.5.
586.5. All right, so closing stock, we have done the working. Closing stock, ACT, that's 103.5. 103.5 FM. Oh yeah, give me the difference.
483.
586.483. 483. Then, of course, the next thing we need to do is to then consider overhead absorption. Okay. So we need to go and do the working for overhead absorption. That will be working number 3 now. Working number 3. We want to determine whether we have under or over absorption. Here will be March. Here will be September. We'll remove all of this. The same approach. So the output in March, for the whole year in that 2015, the company, the budgeted output was 16,000. So for the period ending March, it will be 8,000. Here will be 8,000. Let me put it by the side. Here is 16,000 divided by 2. That's how we arrive at 8,000. Okay, so A2 will be 8,000. Then actual production in March. How many units were produced in March? In March, the company produced 8,500, then September 7,000. 8,500, 7,000. 8,000. 7,000. Okay, so in March, 0. In September, there is under absorption, which is 1,000. All right. So in September, we have under absorption, which is 1,000 multiplied by the fixed overhead absorption rate is 20 naira. Multiplied by 20 naira, that will give us 20,000 naira. Okay. So let's go and put, yes?
Production in March, not 8,500.
Production in March. Is it 8,500? Okay. Let me check here. Yes, thank you. It's 8,500. Error of mind. I was thinking about isn't it? That's why. Sorry about that. So here is 8,500. So you can see here that in March, the budgeted output is less than the actual production. So there is over absorption. Here is 500 over. All right. So I will then come here in March. Period ending March. Let me copy this. PM is interesting if you know what you are doing. March, we have over absorption, 500 units. Put it in brackets. Multiply by 20 naira. That will give us the 10,000 naira. That's over. Okay. So in March, we have 10,000 over. Then in September, we have 20,000 under. Let's go and post. I will then come here. Under slash over absorption. Let me put this one in brackets. Okay. So here is over by 10,000. Deduct it. Here is under by 20,000. You had it. All right. So what do you have here? What do you have here? 473. So 980 minus 473. What do you have?
507.
507. What do we call this 507? Gross
profit.
Profits. Okay, let's bold it. So the next we are going to consider is non-production costs. We consider non-production costs, non-production costs, whether variable or fixed, provided it is non-production costs. So we then go back to the question. We are given variable selling, distribution, and admin, which is 20% of sales. Sales in March was 980. So what's 20% of 980?
196.
196. Okay, 196. All right. Then we're also given fixed. Let's go back to the question. We're also given fixed selling expenses to be fixed selling, distribution, and admin is 180,000 naira per annum, which is 90,000 for March. 90,000 is for March. So we have fixed. I already have it here. In fact, let me remove all of this. Okay, so here is 90. So 90 plus 196, that will give us 286, right?
286.
So 507 minus 286.
221.
221. So that's that for 2000 for March 2015. We then move to September. In the selling price still remained the same. The closing stock in March will become opening stock, which is 103.5. Okay, so direct material remains the same thing as 196. Direct labor remains 126. Then variable production overhead remains 21. Is it 21 or 21.5? Okay, 21, yeah. Then Fish production overhead, 20 naira in September. In September, the company produced, I think this side is closer. Yeah, in September, the company produced 7,000 units. Therefore, 7,000 multiplied by 20 naira. What do you have? Isn't it?
140.
140. So add it up. 103.5 plus 196 plus 126 plus 21 plus 170. What you get?
616.5.
6. Are you sure? Try it again.
Okay, 103. 196 plus 126. 21 plus 14. Okay. 586.5.
586.5. 586.5. All right. So closing stock, we have calculated it before in September, 34.5. Closing stock, 34.5 minus 34.5. Give it to me. What's the difference?
552.
552. All right. Plus 20. That's 572.
572.
All right. So 1120 minus 572.
548.
548. All right. So consider non-production costs. What's 20% of 1120? 20% of 1120.
22,400. 22,400.
224. Right. Then fixed selling, distribution, and admin, 90,000. So this one will give us 314. 314. So 548 minus 314. What you get?
234.
234. 234. So that's the net profits, or you call it profit before tax, under the absorption costing technique. So the next thing we are going to do, even though examiner did not ask, whether examiner asks you or not, you have to prepare your reconciliation statement. So that's the next thing we are going to do, and that's why we are going to call it a day. So quickly, let's prepare the reconciliation statement. Let me copy this. Okay. So we prepare the reconciliation statements. ACT, absorption costing technique, marginal costing technique. So under the absorption costing technique, let me remove all of this so that it doesn't confuse. Let me copy this too. Put it here. Put it here. Now, under the absorption costing, our profit before tax is 221. Here is 234 in September. This is March 2015. Here is September 2015. Okay. So under marginal, 191,254. 191,254. So 221 minus 191, what do you have? That should be 30.
30.
Then this one will be minus 20, right?
Yes, sir.
So that's difference in profits. We need to find difference in stock valuation. To do this, we are going to pick the closing stock under absorption costing. In March, it was 103.5. Here is 103.5. Under the okay, let me just do for 2000 for September. For September is 34.5. Sorry, not here. So for the marginal costing technique, closing stock 73 and then 73.5 and then 24.5. All right. Okay, so what's the difference? 103.5 minus 73.5. That should be 30, right? Isn't it? Are you still there? This one should be 10. Isn't it? Am I on my own? Okay.
Yeah, you're correct, sir.
Then,
You're correct.
all right then. So opening stock under the absorption costing, we don't have opening stock in March, so you put a dash. Under marginal costing, we also don't have opening stock. We put a dash. Dash minus dash. Nothing minus nothing will give us nothing. So we put nothing. So then 30 minus nothing will give us 30. Okay, so that's difference in stock valuation in March. Then, of course, in September, the closing stock in March will become opening stock at the beginning of at the 1st of April. So the closing stock you have in March will become opening stock. So here will be 103 under the absorption, then 73.5 under the marginal costing. So the difference will be equal to 30. So 10 minus 30 will give us minus 20. That's it. That's the end of it. A must be equal to B. All right, this is A. At all time, A must be equal to B. The difference in profits must be equal to difference in stock valuation. That's it. You can see, you are rest assured that you've pocketed 15 or 10 or 20 marks. It's no more than that. When you do this, you'll be very happy with yourself, then you'll be motivated to want to go further. You need 80 marks or 85 marks to scale through to earn 100%. All right, so let me know if you have any question for me. This is the last question under this. By the time we are meeting next weekend, next week Friday, by the grace of God, we are going to be starting relevant costing. I was thinking that these two questions cannot take us more than 1.5 hours. Then I will spend 1 hour to discuss relevant costing, but it wasn't meant to be. All right. So that's it. We spent exactly 3 hours. Sorry, 2.5 hours solving just 2 questions. Imagine that. Just imagine that. So any question for me? Let me see those of you that are still online. Yeah. Ibrahima, Anthony, you are still here with me. Thank you. Chairman, thank you. Chairman Ufobeze, thank you. Chairman Wideze, thank you. Then Ezine, thank you for your support. Frances, I called you. I thought maybe you joined by proxy.
No, well,
Okay,
easily answered, sir, so I then stopped talking.
it's all right. Thank you. Yes, Frank Wisdom, you are the one making noise in my class. Next time, I'm going to hit you hard. Okay, if you repeat it. Then, God's power. I greet you. Thank you. Ahmed Akinwale. Thank you. Ansin, Kingsley, Michael, Ahmed. Thank you. Festus, thank you once again for your support. Then Amarachi, Periside, Sandra, Shola, Atimiri. Techno, who is Techno? KH6. Techno, what's your real name? Talk to me. Techno. Okay. Walter, I greet you. Thank you. Williams, William Wisdom. Then Zoom user 1, Zoom user 2. Zoom user, what's your name? What's your real name? Zoom
Good
user?
evening, sir. My name is Anita.
Anita baby. Yes, Zoom user 2. What's your real name?
Mopelola.
Mopelola. Thank you guys for waiting behind. I want to believe I've touched everyone. So by the grace of God, we are meeting again next week, Friday, when we shall be starting relevant costs for decision making. Last week, I told you to go and read relevant costing that when we meet today, I may likely introduce you to it. But right now we can't do it today. So I need you to go back to your material, go and read about relevant costing. All right. So that next week I can ask you to explain what you have read on relevant costing. Okay. Then number 2, I also gave you an assignment, right? I gave you an assignment to do. So go ahead and solve illustration number 1 in this working note. In this working note, which I'll be sharing later on. So go and solve illustration number 1, and then, of course, you must submit not later than next week Thursday. Not later than next week Thursday, which is July 23rd. Is it 23rd? Yes, July 23rd. So I've already written it down for you. All right. So please solve this illustration number 1 as an assignment. Okay. Solve it as an assignment and submit. The name of the company is Shakara Limited. All right. It's very straightforward. All right. So just apply the principle. Apply the principle the way I solved the 2 illustrations to solve this one too. Okay. It's not hard. All right. So thank you, everyone. I will see you next time by the grace of God. Good night. Bye-bye. Okay. You are welcome. Bye.